Good afternoon, everybody. Welcome to my weekly update for Monday. What is today? April the 13th. So happy day after Easter. Hope you all had an amazing weekend. Got to go out and travel for, oh, wait, no, we're not allowed to do that anymore. Okay, well, then no traveling for the holiday, but hope everybody had a great Easter nonetheless. Let me get the chat box up here. So don't forget, as we are talking today, feel free to post any questions in the chat box. That's going to be the best way for me to get information to you as we're going through the information. So I want to introduce Jeff Lee. Jeff, are you here today? Jeff? Is Jeff here? Did Jeff bail on me? Let's take a look here and see if Jeff's here. No, Jeff. Okay. Well, I only give him like 2 minutes anyway, so he just, no, I'll get 2 extra minutes. All right, well, if Jeff shows up, we'll have him jump in. So let's go ahead and get started. I've got a lot that I want to cover today. As a reminder, guys, I try hard not to go back to prior meetings. Hold on one quick second. I got somebody who's having a hard time getting in. Okay, so I try hard not to go back and repeat information on prior events. Or prior presentations. So if you want the link on YouTube, you can go to youtube.com/JohnLoneKing and you can see my prior recordings from the last 2 weeks. I'm going to go ahead and assume that you've seen that, and I'll reference to a couple of things that might have to do with those things. So hold on one second here. Okay. So let's go ahead and get started. Thank you. I was trying to help somebody get in. All right, so let's talk about the market real quick. I always want to give you guys kind of an update on where we're at with the interest rate market. So right now, the market's doing really, really good. What you're looking at is you're looking at essentially the last couple of weeks, actually the last month, of where the back end of interest rates are. And I want you guys to think about this like the price of a barrel of oil. And how much you pay for a barrel of oil certainly impacts how much you pay for gas at the gas pump, but there's a lot of other factors that come into play. I saw something over the weekend that somebody in, I don't know where they were, Texas or Michigan, had posted that they saw gas prices under $1 a gallon. And in California, that just doesn't exist. The great news is that we are getting, 2 weeks per gallon right now. But the gas price here is significantly more expensive than the gas price in Michigan or Texas. But it's still the same oil. The barrel of oil is exactly the same price. It just translates to a different price at the pump based on lots of other factors. Well, that's what's happening in the mortgage market, and that's always been the case, is you've got what mortgage companies get in return, what rate is expected, and what return that a mortgage company gets from Wall Street. And that's the chart you're looking at right now. The difference is that normally there's a very close correlation between what the mortgage bank pays Wall Street and what they want to get paid by the consumer. And that correlation has completely disconnected over the last month. So what you're seeing right now is you're seeing an uptrend in the last few days. Now, up on this chart is good for interest rates. It lowers interest rates. We had our best interest rates ever way back here. Let's see if I can make my little pointer work. Let's go here and let's go here. All right, perfect. So y'all can see my little pointer right here. So this day right here was the absolute best day we ever had in interest rates. Rates were between 2.75 and 2.99% right here. And then we saw the market get worse, which means interest rates went up. And that happened, we raised rates on consumers because rates went up on the back end. But what you notice is rates the next day went up almost as good as what they were back here, but they didn't translate to the consumer. This is where the disconnect happened. Then rates got a little bit worse, and now rates are getting better. So we're now in the last week of March, March 24th, you see right here. In that last week of March, we are seeing interest rates better than the rates we saw back in early March. Again, up is good. Up means interest rates are lower. We had rates better than what we saw interest rates on the best day in early March, but our interest rates are currently higher than what they were in early March. Depending upon the scenario, depending upon your lender, the best rates you're really going to see right now are around 3.25%. Now that's a screaming low interest rate, but that's still 1/4 to 0.5% higher right now than where rates were back at the beginning of March, and it should not be that big of a difference. So we're seeing a huge disconnect. And what I'm telling my clients is, look, if you're buying a home, just lock the interest rate and close your eyes. Rates are really good. If you're refinancing, it's a horrible time to refinance a home. We get the process started, and then we move forward with locking the loan 30, 60 days from now when we think this market has settled down a little bit. So just want to give you, continue giving you background on interest rates and where they're going. So we see interest rates on a good trend. Again, up is good. All right, moving on from here. I want to talk about servicing, because when it comes to rates, the lenders that service their loans are seeing significantly better interest rates than the lenders who are not. And there's a lot of reasons why. And so I want to talk about that a little bit. So the first thing is SRP. SRP stands for Service Release Premium. That is the money that a mortgage bank is paid, the premium that they're paid when they release the servicing to another bank. So as an example, Summit Funding is a direct seller servicer. We can sell the loan or we can service the loan. But in the past, we've chosen to sell greater than half of our loans because we got a good premium. The investor and the servicer would give us a high return immediately for the fact that we were selling the loan to them via this SRP, or Service Release Premium. MSR stands for Mortgage Servicing Rights. Okay, so right now the Service Release Premium is basically zero. And I'll explain in a few minutes why banks are losing money, or at least they fear losing money on servicing mortgages. So nobody's paying the originating bank a premium to take on the servicing rights of a loan, because in today's market, it's actually a high risk to service a loan. So the SRP value is down to zero, but the mortgage servicing rights, that bank, there is value in servicing the loans, but it's huge risk. And it's that high risk of holding the mortgage servicing rights that makes a buyer of mortgage servicing unwilling to pay a premium. What it really means is, if your lender services their own loans, they can maintain the mortgage servicing rights and they can pass that savings. In other words, there's value in the mortgage servicing rights, and therefore they don't have to charge as high of a rate to the consumer. But if the bank that your client is working with is not a servicer, they don't have the option of servicing loans, they have to sell them to what we in the industry call aggregators, or companies like Wells Fargo, Penny Mac. They aggregate loans. They bring them in to service them over time. Aggregators are not paying to buy servicing rights. Therefore, those banks that cannot service their own loan have to charge a higher interest rate and or higher fees to the consumer just to cover their cost of doing business. Banks like Summit Funding, we can service our own loans. So even though we're not making any money releasing the servicing, that simply means we're not going to release the servicing. We're going to service a majority, all of our loans. Literally going forward for the foreseeable future, every loan that I do, they will make their payment to Summit Funding until this dynamic changes. Again, guys, feel free to post in the chat if you have questions about this. I'm trying to cover deep information on a high-level overview, but I want you guys to understand the really, really big difference here. On a lender that originates loans and they service them, they can deliver better interest rates because they still get some value from the mortgage servicing rights. The lenders that have to sell their mortgages, there's zero value they're getting paid for releasing that to another bank. Therefore, they have to charge a higher interest rate and fee. And you're seeing a pretty sizable difference between banking institutions on what they're charging an interest rate and fee to the same consumer today. And that's something really important to be aware of. All right, so what is it going to mean? It's going to mean better rates to the borrower. It's also going to mean less overlays. So overlays are those additional rules on whether you can allow a lower FICO score or a higher debt to income ratio. Well, if you're a smaller mortgage company and you have to sell to one of the aggregators, not only are you charging a higher interest rate, but you have to cover whatever overlays that buyer of the mortgage servicing is going to add. And sometimes you don't know who you're going to sell it to, which means Wells Fargo might require this rule and Penny Mac require this rule. And so you've got to put together all of those rules and say, well, I got to be prepared either way. So therefore, I've got to make sure the loan meets this rule and this rule and this rule, just in case I need to sell to any one of those institutions. These banks don't have the money or the ability to hold the servicing. They have to sell it, and therefore they have to be able to sell it to many different companies in case any one of them decides they don't want to buy mortgages. That's a lot of what's been happening in the jumbo space, and I'll talk about that in a few minutes. So now I want to talk about the cost of doing a loan, and the cost to your consumer, the cost to your buyer, the cost to the borrower is going up significantly in upfront cost if they're in a high risk category. So I'm basically calling this section risk now comes at a cost. And the way I want to explain that, and I'll go through some slides here to help you understand it, but the first thing I want to explain is all risk in mortgages, kind of like insurance, everything is a risk, right? You got, if you're going for life insurance and depending upon what your age is and your medical history, they put it into a chart and they say, based upon all these factors, this is your risk level and this is the fee we want to earn to offset the risk associated with those factors. The same thing holds true with mortgages. Every risk factor of the mortgage is a fee. So whenever somebody is doing something that is not perfect credit with a large down payment on a primary home, they're going to have a risk factor. In the past, investors have been willing to pay for that risk through bumping up the interest rate. Hold on one second, I heard some background noise. I want to make sure everybody's microphone is muted. All right, so I think we're good. Perfect, all right. So in the past, investors have been willing to say, hey, you know what? If you pay me an extra 0.25% over the life of the loan, I'll gladly pay 1% towards your loan fees. And that is what we would call buying up the interest rate. And there's some reasons why we're not willing to do that right now. And the reasons are pretty simple. Because the investor is saying, well, wait a second. If I bump your rate by 0.5%, and the market continues to improve, rates keep getting better, which we think they will. In a recession especially, mortgage rates typically go down. And so that investor is thinking, well, if I pay up front 1% of your loan amount in fees, and I make back an extra 0.25% per year, it's going to take me 4 years to make back my money. But if rates drop quickly, that person's going to refinance in a year or less, which means it's a losing proposition. And the bank is unwilling in this highly volatile rate market to bet on the person keeping their loan for at least 4 years. So in that case, the investors are simply saying, I'm not willing to write a check up front to get a higher interest rate, especially because the further the rate is up the rate chart, the more likely just a small drop in interest rates means the client's going to see such a big difference in their rate that they're going to jump on a refinance, and that investor did not recoup their upfront investment. The second reason why investors aren't willing to do it is exactly the same concept, how long they get paid back the money. But the problem isn't about somebody refinancing. It's about what I'm going to call loss mitigation issues. People who are losing their jobs. Guys, we all saw it. I mean, unemployment rate is through the roof, significantly higher than it's ever been in the recorded history. And that's impacting people's ability to pay their mortgage. We're going to talk a lot about forbearance today and what I'm calling the forbearance tsunami. And that is absolutely weighing on the minds of these investors that are saying, well, why would I want to pay an extra 1% towards somebody's fees to earn a 0.25% more in rates when 25% of the people probably won't pay their mortgage over the next 3, 6, 9, 12 months. And then who knows what's going to happen after that. And so the investors are very, very concerned. Linda asked, why don't lenders, Linda, I'm not sure I understand the question. Can I unmute you, or do you want to type a question? Why don't lenders season again? I'm not sure I understand. So if you could clarify that either by unmuting or by typing in a clarifying question, I would appreciate it. All right, while I wait for Linda to come on, or to, why don't lenders do seasoning? Again, I'm not real clear where you're referring to. Like, are they, if you could give me a better example, maybe. Okay, so while Linda's typing up a little better example, I'll move on to give you guys some samples of what this looks like. in the market. So the first chart I'm going to show you guys is what the risk cost is as an example. And so this chart is something that I deal with every single day. And this top chart is for all mortgages greater than 15 years. And what you'll see is, hey, if you're putting 40% down versus 30% down versus 20 versus 5. And so it has to do with your loan to value and your credit score. And then down on the bottom here, we see another set of charts. And this one, the one I want to point out is the investment property adjustments. This is all fee. So all of these things you're seeing is an additional fee on the loan. And so what I want you to pay attention to is right here, the 740 credit score, putting 40% down on a primary home. I pulled these interest rates today. Today, somebody who's buying a home with great credit, with a big down payment, they're going to get 3.25%, and they're going to pay a little less than a point. They're going to pay about 0.75% in fee. If that person wanted to get a lower fee, no problem. We can bump that rate by 0.5%, and we drop their fee by almost 0.75 points. So even though I said investors really aren't willing to do it, it really depends on where we're at in the interest rate range. And I'll show you a real stark example here in a second of what I mean by that. So hang with me and it'll all make sense. If that same client said, you know what, I want to buy down my interest rate, paying an extra 1.25 points only gives them another 0.25% in rate. So buying down your interest rate for a primary residence with great credit doesn't make a lot of sense. But the investor is happy to charge a little bit extra to buy up your interest rate if they want low fees. As a matter of fact, the sweet spot right here would actually be 3.375 because there's a relatively small amount of fee for that. But again, I won't get too deep in the weeds. But now, guys, I want to show you the exact opposite alternative. And the only thing I'm changing is I'm making it an investment property. And so for the same scenario, all I'm doing is adding the fact that it's an investment property. We still have somebody that has a 740 credit score. We still have somebody that has a 40% down payment, but the only difference is we've made this an investment property. And again, these are literal today's rates. So that rate with 1% in fee is 4.75%. That is a huge bump in interest rate. Remember, we had 3.25% with less than 1% in fee when it was a primary home. But for the investor to pay this 2.125%, the investor says, look, I want a whole bunch more in rate. I'm going to raise you 1.5% in interest rate every year simply to pay 2.125% in upfront fee, okay? If you then said, hey, so what I want to do right now is compare the two scenarios. And essentially what I want you to see here is if you buy down, so on the right side is your, on the right side is your investment property. You get a pretty decent rate of 3.625 if you're willing to pay 2 points. And that's really what I want to point out today is the buy down. Paying 1 extra point on an investment property took you from 4.75 to 3.625. Going from 1 point to 2. On a primary home, going from 1 point to 2 only lowered you 0.25%. So hopefully this makes sense. The cost benefit of paying fees to lower your interest rate is significant when you're looking at investment properties or really any high risk loan. There's a lot of factors that went into whether it's a high risk loan. Investment property is one of them. Low credit score is another one. So when you have clients that are doing high risk conventional loans, don't talk to them about low fees. It isn't the case. I want to talk to them about, look, you have to pay for your risk in having a higher fee as opposed to what you're used to seeing, which is, hey, I have a client last week, by the way, that called me and said, hey, John, I've got a huge down payment on an investment property. I have great credit. I want a 0 point loan on that investment property. His rate would be 5.375, and I still would have to charge him a quarter or almost 0.25% in fee. There's no such thing as a 0 point loan for an investment property. Yet on a primary residence, we can get almost 0 points at 3.5% interest rate. So hopefully this helps a little bit in understanding why paying points in today's market makes sense, and you need to prepare your buyers for that. If they're in a higher risk category, and I'm actually going to back up a little bit here so you can see the risks. So this is a majority of the risks that you're looking at. So it's credit score, and you start seeing that, hey, if somebody's got a 660 or lower credit score, we're going to add 2.75% to their fee. That's an even bigger hit than what we just talked about for the investment property. Even if they have a 680 to 699 credit score, we're going to add between 1.5 and 1.75% in their fee, even with a 20% down payment. So high risk isn't what you think is high risk. Somebody with a 680 credit score and 20% down shouldn't be considered high risk. But the truth is that person should plan on paying 2 points to get their 3.25% or 3.5% interest rate, because to pay less than 2 points would mean they're having a significantly higher interest rate, and the numbers just don't make sense. All right, so Linda, you said they used to say you couldn't do a refinance for so many months. I thought it used to be 2 years, so that it had to be seasoned before you can refinance. So that's an urban legend. So there used to be prepayment penalties, and prepayment penalties went away. Now there's an early payoff penalty that we as lenders are charged if somebody refinances or pays off their loan within the first 9 months of having the loan. But we can't force somebody to keep the mortgage. The financial, what do you want to call it? The Dodd-Frank Financial Reform Bill changed all of the rules for us, and so we cannot force somebody to keep the mortgage. They can refinance at any point in time. If they added prepayment penalties back in, and I'm not advocating prepayment penalties, but if they added prepayment penalties back in, it would fix that whole issue of investors being worried about being paid off quickly. But the law changed in 2011. And that law now says we can't charge a prepayment penalty and we can't prohibit the consumer from refinancing. Now, FHA, VA, those loan programs have specific rules that preclude somebody from refinancing for a certain period of time. Conventional loans do not. So somebody could buy a home with you today, get a higher interest rate so they don't have to pay much in fee, and then refinance in 6 months or 3 months, and the originating bank loses all of their income, but there's absolutely nothing we can do about it. And we have to build that into the dynamics of the market and our expectation of whether the investor is going to recoup their original investment. So hopefully that helps answer your question there. All right, so you guys have any questions about this, feel free to post it before I move on. I think this is relatively complex, and I want to make sure that you guys understand why people need to plan on paying points, because when they have a higher risk loan, those points pay off significantly and can give you a much better interest rate compared to a low risk loan where paying points doesn't really matter. All right, sounds like that's covering what everybody has. All right, perfect. So now I want to talk about the forbearance tsunami. So here's what we're dealing with. The first thing is, guys, I need your help. Screaming from the rooftops, postponement is all they get in a forbearance. There is no forgiveness. And I'm hearing it over and over again from my clients right now that are thinking, hey, John, I've got the money in the bank. It's I put it in there for a rainy day fund, but I don't want to spend that money if I don't have to. I get it. I totally understand. If you can keep that money in the bank, you are way better off overall than spending the money. And so they're looking at it saying, well, if I can do a forbearance, then I can, even if it's just a postponement, that's okay. I'll pay it back at the end of the loan. But for most investors, you're not paying it back at the end of the loan. I went over this last week. That money is typically due after the 3, 6, 9, or 12 months of forbearance. The second thing is it will impact your ability to borrow money in the future. Now, what did the federal government say when they rolled this out? They said this will not impact your credit. And they're right. It is not going to impact your credit score. But lenders are not going to ignore the fact that somebody didn't make their mortgage payment. It's part of the overall risk profile. And I know this may sound like I'm not being empathetic to people who have lost their jobs. I'm being extremely empathetic to people who have lost their jobs. But from a credit risk profile, it's kind of like being empathetic to somebody who lost their job in 2008 and had to file bankruptcy and go into foreclosure. Totally understand, that's why those tools are there. But that doesn't mean the bank has to ignore those things that happened and be willing to give that person another loan in the near future. And so what we're dealing with, I'll show you in a minute, is this stuff is showing up on your credit report. It isn't impacting your credit score, but it's showing up on your credit report. And I already have situations that it's impacting a borrower's ability to qualify for a mortgage today. And I'll explain that to you in just a minute. Before I get there, I want to talk about the tsunami, okay? So the top line is all mortgages. What percentage of homeowners are in forbearance? As of March 2nd, 1/4% of all homeowners, and I should say people with a mortgage. So this doesn't count homeowners that don't have a mortgage. 1/4% of those people were in forbearance as of March 2nd. March 30th, that number skyrocketed to 2.73%. A week later, another huge jump, 3.74% of borrowers were in forbearance. And guys, we're only a few weeks into this. It gets worse on FHA and VA. So what you notice is back at the beginning of March, before this all happened, fewer FHA and VA borrowers were in forbearance. So that's a weird dynamic to think these are people that typically are putting lower down payments, a little bit more credit challenged. Judy, I'll get to your question in a second. And so you would think a greater percentage of them would be in forbearance, but historically that's not the case. Yet you see the biggest spike is in FHA and VA borrowers, Ginnie Mae securities. From March 2nd to March 30th, we went from 0.19% of people, of homeowners, of mortgage holders were in forbearance to 4.25% of people with a mortgage were in forbearance. A week later, it went up again to 5.89%. We are almost at 6% of mortgage holders that hold an FHA or VA mortgage are currently in forbearance. That is a huge drain on the mortgage industry, and I'll cover in great detail over the next couple of slides what that means. Before I go on to that, let's see what Judy says. What if you're approved for a forbearance? Let's say that 6 times fast. Approved for forbearance. Approved for a forbearance, but you make all the payments. Does this hurt your credit if you make all the payments on time? That's an amazing question, Judy, and I'm actually about to answer it for you right now. So before I move on, guys, I want to point out right here, the guidelines on Ginnie Mae securities, which is FHA and VA products, those guidelines have tightened the most of all programs. And here's why. Like it's right here in this slide, significantly more, I mean, almost double the number of borrowers are in forbearance for FHA and VA compared to all mortgages combined, which means the number of conventional people is significantly lower than the 3.74. Because guys, this is the average of everybody, including these these people down here. So our conventional borrowers are not going into forbearance anywhere near as quickly as our FHA and VA borrowers are. So let's talk about how this impacts a borrower. And this actually is exactly what Judy is talking about. This is what we call a trade line. So what you're looking at is a snapshot from one of my clients' credit reports. I pulled this credit for a client last week on Thursday as I talked to this client about refinancing their mortgage because rates have dropped significantly. They actually were a pretty high risk client when they did their loan late last year, and they got a 5.25% interest rate because their credit score was low. They had to pull some cash out to pay off some credit cards and get their debt right-sized, and rates were higher. And so they're at a 5.25% rate. I can refinance them right now to about 3.25. It's going to save them about $300 a month. But I pulled her credit, and this is what I saw. Affected by natural or declared disaster is what it says on the credit report. And I asked this client, as I saw this, and I think to myself, okay, where's this home? Oh, that's right, it's in Lodi. So does anybody want to tell me what the recent natural or declared disaster, did we have a tsunami in Lodi? No. Hurricane? No. We might have had an earthquake, I think, last week, but it certainly wasn't declared a natural disaster. Guys, there has been no natural or declared, let me rephrase that, there has been declared. There has been no natural disaster in Lodi. And so I immediately say to this client, hey, did you happen, and mind you, I've never ever seen this on a credit report other than a few circumstances, but nothing recently. And I said, did you happen to talk to your bank about a forbearance? And she says, well, yeah, why do you ask? And I said, well, are you in a forbearance? This is where it gets even better, Judy. So she says, well, kind of, but not really. I said, well, what does that mean? And she says, well, about 3 weeks ago, when I heard on the news that everybody could get a forbearance for 3 months, I thought to myself, man, if I could put 3 months of payments on the end of my mortgage, that would just help out our cash flow a lot better and put us in a better financial position. And we'd have an extra cushion of 3 months of payments in case this kind of extends out longer. So sure, why not? So she picked up the phone and she called her servicer, and the phone rang, and it rang, and it rang. This is so much fun for me, guys. The drama of dragging out the story is just, I'm loving it. So the phone rang and nobody answered. Okay, she couldn't get hold of a single person. I'm sure we've all heard that story where people are calling their servicers. The servicers are overwhelmed. They don't have enough capacity to answer the questions from all of the people who are calling in with forbearance requests. So she went online, and right there on the website for her bank, she logged into her mortgage account, and right there on the top of the screen, it says, click here to request a forbearance. She goes, awesome, because that's why I was getting on the phone, but they wouldn't answer the phone. So she clicked the button, and she heard nothing. She's heard nothing for 2.5 weeks. Last week, like 2 days before, two days before I talked to her, she said, finally, because I go, okay, so are you in forbearance now? And she goes, well, no, because I called the bank again because they had never mailed me anything. After 2.5 weeks, they haven't emailed her, they haven't mailed her, they haven't called her, they've done nothing. All she did was click the button on the screen. And she calls the bank and she says, hey, I'm trying to apply for a forbearance. And she finally gets through to somebody and says, what are the terms? When am I going to owe the money back? And they told her exactly what I've been telling you guys is the most common answer. And they said, well, you get to skip April, May, and June. And on July 1st, you have to make all 4 payments. And she said, no, that's silly. I'm not going to do that. Okay, thank you very much. And she hung up. And she goes, John, I mailed my payment the next day. I paid it on time. I'm going to pay every single month. I'm totally not going to do this because there's no benefit to me for doing that. And I said, awesome. Did you tell the lady when you're on the phone that you didn't want to do the forbearance? And she said, well, no, we never even pulled up my account. I was just asking her in general how it works. And when she told me, I said, no problem. I wasn't going to do it. But guess what? I've now run this file up the underwriting flagpole. I am the first person who's run into one of these that says affected by natural or declared disaster. And I didn't want to wait a few weeks until it got into underwriting to find out how we're going to treat that. And it's very simple. And Judy, this goes to your question. I have been told, even if I prove that every one of her payments was made on time and that she never took advantage of the forbearance, she still is in the status of forbearance. It's kind of like if we think back to 2008 and somebody didn't make their mortgage payment to the point that they had a notice of default filed. That means they started the foreclosure process, but they never let the home go to foreclosure. They caught it up somehow. They modified the mortgage, whatever they did, but it still was treated like a foreclosure in the eyes of the bank that tried to do a new mortgage for that person. Because you let it get to the stage of being in the foreclosure process, and that was enough for the bank to say, then we deem you having had a foreclosure. And what we're reading right now, what we're understanding from the industry right now, is when it says affected by natural or declared disaster, unless you can prove there was a hurricane in your backyard, and that's why your mortgage was affected by a natural or declared disaster, you are considered having been in forbearance, and that makes you a high risk borrower that banks are currently not willing to lend on. How long until we can lend on it? We have absolutely no clue. I have a couple of thoughts, and I'll answer those in just a second. Judy says, can or how to cancel the forbearance agreement? I have no clue, but my client's about to figure it out because she's going to want her 3.25% interest rate. And so I've now got her on the quest to get a hold of her mortgage company and see if we can get this removed from her credit report. And that's the only way I'm going to be able to do her mortgage, and she's going to be our guinea pig to figure that out. And we're going to die trying. So we're going to fight every fight we can because she didn't choose to forbear. She was trying to get information about forbearance, couldn't reach anybody on the phone, so she clicked the button online. She never agreed to anything. She never got any terms, but clearly she was approved for the forbearance because they put this notation on her credit report. So significant impacts to the borrower down the road by simply inquiring about a forbearance. And that is not how this was rolled out, but it's absolutely how it's playing out. Now, what do I think this is going to look like? In my opinion, it's going to be at least 12 months from when they start making their payment again. There is currently no rule regarding forbearance in the mortgage guidebook. Now, maybe they're going to add one, and maybe it says, hey, if you've ever been in forbearance, you can't do a new mortgage for 2 years after you started paying your payments again, or 3 years. You're in a penalty box, kind of like you are with a short sale or a foreclosure or a bankruptcy. I don't know if that will happen. But what I do know is we always look back to the most recent 12 months of payment history. And so if we have a recent 12 months of payment history that includes payments that were forborne, is that a word? Forborne? Forbeared? Anyway, I'll get Mark Edwards to give me some grammar lessons on that. So the bottom line is that I don't know what the word is, but if they forbeared, then I don't think they're going to be eligible for a mortgage until they've made 12 months of on-time payments. Guys, that is a total guess, but it feels right. It feels right based on the guidelines that I know and what I see out there. Nobody's willing to say for sure because nobody really knows for sure. But I'm going to put it out there to say, at the very least, I expect somebody's not going to be able to qualify for a new mortgage. Now, it's not going to hurt their credit. It's not going to hurt their credit score, but it'll put them in a penalty box. And I believe that penalty box is likely to be a year from when they start making their payments again on time. This is huge in how it's going to impact potential borrowers when most of them, I won't say that, some of them could have made the payment, but we're told by the media there was nothing negative about doing a forbearance. Go ahead and do it. There's something significantly negative about doing a forbearance that is going to harm the consumer for the foreseeable future. All right, feel free to post if you have any questions about that. I'm going to move on to the impact on the mortgage industry. I'm going to be really clear. I've got borrowers who I'm talking to about forbearance that they don't care about the mortgage industry. I understand that. The last thing they care about is, whether a mortgage bank is going to survive, whether the mortgage industry is making money or not. Like, that's not their concern. Their concern is their economy of their household. And I fully understand that. So when I'm talking to a consumer, all I'm talking about is the prior slide and the fact that they need to be aware that there will be some consequences. But if that's their only option, it is the right thing to do. But they absolutely need to be aware that not only will they have to pay back the money, and likely very soon, but they also need to be aware that there will be some short-term consequences that could be even longer lasting. So Nancy asked, how is this expected to affect future foreclosures? Now I'd really be speculating. There's a lot of questions out there right now about where this is going to end up in 3, 6, 9, and 12 months. So to be clear, the rules say, if your loan is backed by a government entity, Fannie Mae, Freddie Mac, FHA, or VA, you can get up to 360 days of forbearance. Banks are only granting them in 3-month timeframes. So I would imagine July 1st, somebody's not going to be able to make all 4 payments. The bank's probably going to say, okay, fine, we'll punt for 3 more months. So that means on September 1st, October 1st, they're going to have to make 7 payments. And then they're not going to be able to do that. So they're going to punt for another 3 months, and they're going to punt for another 3 months. And I'm hopeful that we don't get to the point that we have a whole bunch of homeowners that are a year out and not making mortgage payments, because we will be in a deeper problem at that point in time. But at some point in time, Nancy, I expect that they're going to have to start modifying these people. And at some point in time, what I'm happy about is that most of these mortgages are fixed rates. The modification's going to mess with that, because a modification may make their payment a temporary interest rate for a certain period of time. And so I think a lot of these people are going to sell their homes. I think that people have a lot of equity in their property right now. And so they better sell, because the saddest thing for me is somebody who gets a foreclosure that has equity in the property. And so the hardest part for you as realtors is finding these people early enough in the process and being able to explain their options and guide them on how to A, keep their home, or B, how to sell it before it gets foreclosed and they lose the equity they have in the property. And you're asking, how's this going to affect future foreclosures if people have to make 4 months? Exactly my point. They're probably going to modify. The bank will foreclose at some point in time if they don't make the payment, and the payment's going to go up because the modification is going to mean you have to pay back that shortage over a period of time. Now, the banks can play around with how long that period of time is, but there's impacts to the mortgage industry that will create challenges there. Okay, so I got a question from Kathleen. It's called kicking the can down the road. That's exactly correct. Can they do a modification? Yes, I think that they can. I think that modification is simply the bank saying, hey, I'd rather modify than to take this house back in foreclosure. And so, yeah, I do think that modifications are likely going to become a bigger and bigger piece of the puzzle. My concern is modification in and of itself creates a challenge for us to do a new loan for somebody once they've modified their current mortgage. And so that piece also is going to create a problem for people being able to qualify for a mortgage down the road. All right, I'm going to switch from the borrower side to the impact on the mortgage industry, because although most consumers don't think about the health of the mortgage industry, the truth is they have to. They absolutely have to. And so there's a couple of things here. First of all, on servicers, I've talked about this already. So servicers still must write the check to cover the epitome. The epitome is principal, interest, taxes, insurance, and mortgage insurance. All of those things have to get paid. All of those things have to get paid, and the servicer is on the hook to write that check. I said this last week. I talked about the bank servicers can borrow money from the Fed. The non-bank servicers cannot. The Fed has the power to create a lending window, an opportunity for banks, for mortgage banks, to borrow money and fund this payment of the principal, interest, taxes, insurance, and mortgage insurance. The problem is that window has not been put into place. And I'll talk to you in a couple minutes about what that looks like. So the non-bank servicers don't have a place to borrow the money because their biggest assets is their accounts receivable, is the servicing portfolio. And I just mentioned that mortgage servicing rights still have some value, but about half the value they used to have. And so you've got an asset that a lot of banks have already borrowed money against, and they have no more room to borrow because the value of that asset has gone down. But today, I want to talk more about how that's going to impact the originating bank. So the originating bank being Summit Funding or any other bank that is the bank that starts the mortgage, whether they ultimately service it or not, or if they sell the servicing, they're 100% selling the investment. Here's what we know today. We know today that if a borrower inquires, and I showed you a minute ago what an inquiry looks like on a forbearance. If the borrower inquires about a forbearance prior to their first payment dates, it is a non-saleable loan. That means Summit Funding cannot sell that mortgage to Wall Street. We cannot get our money back that we loaned on the warehouse line of credit. Therefore, we cannot pay back the warehouse line of credit. That'll cause two major issues. The first thing is the warehouse line of credit can actually restrict a bank's rules on when they can fund a loan under what criteria. Let me say that in a different way. Even if Summit Funding, and by the way, Summit isn't having these problems and I don't expect us to, but even if Summit services our own loans and we sell the loans directly to Fannie Mae and Wall Street, we still have to deal with the mortgage warehouse line of credit and their trust that we will be able to sell that mortgage and pay off their line of credit. So the warehouse bank can say, hey, Summit Funding, we're not going to let you fund any more mortgages that are below this credit score. Or the warehouse bank can say, hey, Summit Funding, we're not willing to let you fund any more mortgages that have a debt-to-income ratio above this debt-to-income ratio. And that has nothing to do with the investor or the servicing ourselves or our level of risk, but it comes to the warehouse bank's level of risk. Summit Funding is very, very well capitalized. We're actually one of the favorites of all of the mortgage banks in the eyes of the warehouse lenders. So we don't deal with this right now because they know if we can't sell it, we have the money to write a check to pay them off out of our bank account. Many other banks don't. That's where you're seeing a lot more overlays. That's where you're seeing a lot of banks restrict their guidelines, not because they want to, not because Fannie Mae is forcing them to or FHA is forcing them to, but the source of the interim funding at the time that they close the mortgage says, hey, look, if something changes and this borrower goes into forbearance before the first payment is due, you won't be able to sell this mortgage. Do we trust you have the money to pay us back? No, we don't trust you. Then we're not going to let you fund loans that meet a higher risk criteria. That is a very, very real issue right now in the industry. And those warehouse lines of credit can change those rules in a heartbeat. So you could have a loan that is signed today, ready to fund tomorrow, and a bank may have ample warehouse line space, ample space on their line of credit, but they can't find a warehouse line willing to fund it because all of their warehouse lines cut back their guidelines. And so you can have a loan ready to fund that will not fund because the warehouse line right before funding said, nope, we're not willing to accept this criteria any longer. That means that you might not be able to fund the loan tomorrow because of the fact that the rules changed. And more importantly, is when you cannot pay off your warehouse line, it's kind of like going to the grocery store with a maxed out Visa card. You're crossing your fingers and praying that when they swipe the card at the check stand, that there's $100 still left on there because hopefully that payment you mailed last week went through. Hopefully the check didn't bounce, right? I mean, unfortunately, that's the truth in society, and it's the truth in the mortgage banking world. And so mortgage banks are hoping and praying that hey, hopefully the post-closing department sold enough loans yesterday to pay down our line of credit so that we can fund these loans today. But every mortgage that stays on the warehouse line longer means less room on that warehouse line to fund the next day's mortgages. So it could be they won't fund tomorrow's mortgages because the rules change for the warehouse lenders, and it could be they simply have no more room in their line of credit. But we are going to see that over the next 30 to 45 days, and we're going to see banks unable to close loans, and I've already heard some stories of it happening already. The final thing is banks could literally have to pull money out of their own assets to pay off the warehouse line. I think I've talked about that. All right, so I want to give you an example. So Kathleen says, how long do you see this issue continuing? For about a year. I mean, it's really how long, it depends on where this forbearance issue comes in, because this is all predicated on the job loss and people getting a mortgage and forbearing right away. And so I think it should be resolved within a year, because the truth is we have 11 months left in the forbearance window that the government put out there. So let me give you an example of what this means. You have a loan that a mortgage company that in March of, I meant to say 2020. So last month, March of 2020, funded 1,700 loans at an average of $300,000 a loan. So that's $510 million we funded on our line of credit. Okay, no big deal, because that company may have, a $1 billion line of credit. So you can fund half your line of credit this month, and you still have room for more loans next month. But first of all, if you can't sell those loans off as quickly, you only have about 2 months worth of average fundings, and then you're out of money. But here's where I want to talk about where it's more critical to the industry. Let's pretend 5% of those borrowers request a forbearance. And remember, it's about inquiring about a forbearance. It's not about actually doing the forbearance that matters right now. What matters to the mortgage industry is if somebody requests a forbearance. Remember, these people that funded last month, so I apologize that I put the date wrong there. If 5% of those borrowers request a forbearance prior to their first payment date, that's 85 loans that cannot be sold. At an average of $300,000 a loan, that's $25 million in assets that are needed from the mortgage bank like Summit Funding. I told you we are well capitalized, but I can also tell you we're not going to go very long with writing checks for $25 million a month out of our asset account and survive. And that's the real struggle that mortgage banks are up against. And that's where some mortgage banks are already being liquidated. The owners have said, there's no way I'm going to survive this. I'd rather sell right now than to completely fail. And there are mortgage companies that are on the M&A market, mergers and acquisitions. There are mortgage companies on the M&A market right now at a fire sale price. I'm not saying this to create, concerns or to overblow it. It's a fact. And so we've got companies that when you have $25 million in assets that are sitting on your warehouse line, you have two options. Your first option is write a check to pay off the mortgages. Now you own them, and at least you have an asset, and you hope at some point they'll pay. The truth is, you will get your money back, because if they go into forbearance and they don't pay, you will get your money back from Fannie Mae or Freddie Mac or Ginnie Mae. And so the mortgage bank's not going to lose money. But can you survive long enough to get that money back down the road? That's the key question that our industry is facing right now. So they can hold the loans, keep the assets as account receivable, and hope they start paying. Or option two is they can sell that $25 million of loans on what we call the scratch and dent market. Scratch and dent market is exactly the same as when you buy canned food at the canned food outlet. It fell off the truck and it got dented. The food on the inside is just fine, but it's dented and they can't sell it for full price. So depending upon the reason for scratch and dent, it might be a 5% haircut. It could be 25 or 50% haircut, which means we could be losing $5 to $15 million by just writing a check off the top to cover those losses. Again, the average mortgage bank operates on really, really thin margins. So that's the worry right now. That is the issue that is keeping owners of mortgage banks awake right now. They literally are having insomnia over this issue, because nothing will crumble the mortgage industry faster than somebody closing a loan and before their first payment, picking up the phone and inquiring about a forbearance. They can't last very long. I want to tell you another quick story. I had a client that I closed a loan for last month. We closed on the 3rd week of March. His first payment is due May 1st. He literally emailed me this morning, John, I'm curious who I talk to find out about forbearance options for my mortgage and what that will look like. That loan will not be able to be sold because he's inquiring about forbearance. Now, that's the first that I've had. It's not the first that Summit Funding has had. This is a very, very, very real problem, because the originating bank is on the hook if they originated a loan that does not perform right away. And the originating bank does not have enough funds to cover that. It's a major, major concern. So what's the government doing to help? So first of all, Ginnie Mae, who insures FHA and VA loans, they're stepping up. They announced last week they're going to loan money to banks to cover the principal and interest payment on the missed loans, but they're not going to cover the taxes, the insurance, or the mortgage insurance. The FHFA, the Federal Housing Finance Agency, oversees Fannie Mae and Freddie Mac. Director Calabria, whatever his name is, that dude, his solution, literally what he said is, if a bank cannot cover the funds that they are short, we will solve the problem by transferring the servicing assets of that mortgage company to another mortgage company that has the financial backing to manage it. Their solution is literally taking the income producing asset of these mortgage banks and ripping it away from them because they don't have enough money to cover these short-term losses. The FHFA is planning, this is my opinion, but it's pretty clear, they are planning for some mortgage banks to fail. And I said it last week, I think it's political. They want to see some blood in the streets before they bail out the mortgage industry, or at least that's what it's going to be viewed as a bailout. And people don't understand what I'm explaining to you right now. And so if they start giving money to the mortgage industry, it's going to be seen as another bailout of the banking industry. And the politicians don't want to be seen as doing that. So they're going to want to see blood on the streets before they let that happen. All right. Now let's go to some easy stuff. First of all, I don't know if Jeff Lee is here. I did not see him show up in participants. Jeff? No, Jeff? Okay, perfect. Guys, feel free to post questions if you have any questions. I'm going to cover some really basic overview stuff right now. So FHA, the rules have been in flux from lender to lender. Right now we're at a 620 credit score with some extra overlays, reduced debt to income ratio, et cetera. But at a 640 credit score, we'll do anything. So you can say if somebody's got a 640 or better credit score, we're treating FHA like normal. We'll go down to 620 with some exceptions. I've seen some banks raise their credit requirements to 680. I've seen some raise it to 680 and then lower it back down to 660. So they don't know where they're going to end up. But I know these recent numbers in forbearance requests on FHA and VA loans is definitely creating more concern. And it is, in my opinion, going to continue to restrict the guidelines specifically on FHA and VA loans. Conventional, serious concerns about self-employment income. Summit Funding has no rule on this, but many banks are adding overlays relative to the fact that, do you count all of somebody's self-employment income or do you not? Are they really making the money now that they had been making historically? Some banks are requiring a self-employed person to provide receipts of income equaling what their average month of receipts were for the most recent 30 days. Most self-employed people are not receiving 100% of what they'd received before. But a lot of them, and I'm talking about before this crisis, but a lot of them, their expenses have dropped significantly because they don't have the same staffing expense or other expenses. And so maybe their profit is staying the same. But some banks are saying, we don't care about that. We want to see that your gross receipts haven't changed. Otherwise, we're not going to lend to you. Rental income, credit scores are major issues. I believe it was Citi. If I'm wrong, then I'll apologize to Citi. But I saw an article today that talked about a large bank. Again, it could be Chase. It started with a C. It's either Chase or Citi. A large bank announced today no more mortgages under a 700 FICO score at all, and no more mortgages with less than a 20% down payment. Broad stroke across all of their product lines. No more low FICO score, no more high loan to value. So huge issues there. Summit Funding, we no longer have jumbo products. I had two investors left 2 weeks ago. Last week I had one investor left. As of last Friday, the last investor stopped buying loans. Or let me rephrase that. We stopped trying to sell to them because we've got loans that we've closed that they're finding every reason not to buy and trying to force us to buy them back even though we met every one of their rules. So that last investor, we actually stopped doing business with them, and we'll have to deal with the loans we closed, but we're not closing anymore. So just be aware of the fact that your big banks are going to be your best source for jumbo loans. If they don't fit in the big bank box, we've got great options to do a first mortgage conventional loan and a HELOC second that can go up to 90% loan to value. So that's a very viable option. And again, remember, jumbo lenders have to cover their own losses on forbearance. They don't have a backstop of the federal government. They're loaning their own money out of their portfolio. Super high risk, and it's a market that nobody wants to invest in right now. Turn times and closing, we can still hit 30-day closings. Make sure that we've got to call the borrower the day of or the day before funding to prove they have a job. The IRS no longer requires, the IRS won't give us transcripts, and we're not requiring them anymore. So that's a win. Major issues on verification of employment. I went over this last week, but I want to go over it again. Huge concerns about people having their job at closing. We have to verify the day of or the day before we fund. And if there's a delay in closing, we have to verify again. And so very small window. I will tell you that I told you 2 weeks ago when we rolled this out that we were one of the most conservative in that front, and that many banks were a little more relaxed and maybe doing it within 3 or 5 days of closing, and we were requiring it the day of or the day before. Now I've talked to a majority of my peers, and most people have changed their guidelines to match ours. Almost every bank that I've talked to requires day of or day before verification of employment for employed or self-employed people. All right, title and escrow issues. Jeff's not here, so we will move on from there. Guys, do you have any questions for me about anything? I know we've covered a lot today, but I'm super concerned about what's going to happen with the industry with all of these forbearances. The fact that the FHFA is not stepping up and providing a solution to the liquidity crisis that banks are about to face with forbearances it brings up the question of how secure is a home mortgage and how secure should investors feel about investing in mortgage bonds down the road? Because we have the implicit backing of the federal government on all of these mortgages, and the time when we need that backing the most, the federal government is standing on the sidelines, at least with Fannie Mae and Freddie Mac, and saying, let's see what happens and let's just let people fall and we'll transfer the assets to somebody else. Major concerns. Please help me spread the word to consumers about forbearance. It is more than just a question of having to pay the money back in 3 or 4 months. It's a question of their ability to borrow in the near future. And I kid you not, it's a question of survival right now for the mortgage industry as you know it. And if we don't solve this issue together, no one of us can solve it, but together we all can. And we have an obligation to back the mortgage industry and keep it solvent. All right, are mortgage insurance rates going to go up because of these issues? I have not heard that, but that's a great question, Kathleen. I don't know. Judy, it's It has been said, if you want to keep your customers, give your customers value today in an uncertain market. Well, thank you. I appreciate that. I won't read the rest of it because then it's just self-serving. The bottom line is, thank you, Judy. I appreciate the kind words. To all of you, if you have questions, feel free to call, email. I'm here to help. And if you guys want to talk to me about this information, I'm happy to present it to anybody else that you know that needs that information. Have an amazing day, guys. We are right at 4 o'clock. See y'all later. Bye.